The only other thing that I've got that I think I would consider is with the mastermind group. What we're going to do, and what I've taken an interest in, and what we're going to kind of do as part of the mastermind for the foreseeable future is we are going to read some books and listen to interviews by billionaires, whether they are in real estate investing or not, and kind of the wisdom imparted by billionaires about money and markets, I believe, are pretty interdisciplinary. So they don't necessarily have to be real estate billionaires in order for their advice to be prudent and applicable to real estate investing. So we have been going over Howard Marks for quite some time. I know I've mentioned Howard Marks on the last couple of live streams that I've done, and he has a kind of hedge fund or some type of fund, but he made a decent amount of money in 2008 from investing in distressed assets. And he's done some pretty good interviews at schools and on news channels that we were able to glean a decent amount from. And pretty much his big takeaway that I've had at the moment is when it comes to investments, kind of sitting on the sidelines isn't an option. Making the best investment decision on the options at hand is about all that you can do. And he really doubles down a lot on people that speculate. He's the guy that said there are two types of economic forecasters: those that don't know and those that don't know they don't know. So he says that the variables are so vast, and what could potentially happen, there's so many different options that you have a significantly higher chance of being wrong than right. So be leery of trying to forecast things and make the best decisions that you can given the information that you have on hand. In addition, he says it's the access to the information. And one of the first questions that I think his son, who may work with him, asks when they're looking for or looking at an investments is, who knows this? And I think, if you are able to get information faster, then you might have the ability to make better investment decisions based on that information at hand. All of that being said, the way that I've overlaid that to the real estate investing model that we're currently doing is, what the real estate market is going to do in the future is completely unknown, even by people that are in real estate, every day. People have feelings that recessions are coming, but there's no way to know that. So all of the properties on the market, all of the deals that come our way, we analyze them as we would normally, and we purchase the ones that make sense, and we don't purchase the ones that do not. And while we are protecting our portfolio from a global perspective by having healthy reserves, limiting the number of large open projects that we have by keeping our vacancy very low, we're not doing any speculation on what the market may do in the future. And I know that our investing portfolio is pretty young. We've only been doing this for like 5 years. So anything that I could possibly say on this subject could totally be used against me in the future, because I don't know. However, one thing that I think is noteworthy is when I first got interested in investing in real estate back in 2016, all of the podcasts and all of the real estate investing informational people, anybody that produced content about real estate investing was speculating on an upcoming recession because of the way that prices have risen. And since 2016, they haven't done anything but continue to rise. So I met several people in 2016 that were very vocal about them sitting on the sidelines waiting for better deals to come, and they have moved on to other things at this point. They're not doing anything in real estate investing. If we chose to sit on the sidelines and wait back in 2016, we wouldn't have near the portfolio that we do now. At this point, I would argue that if a recession were to occur, then we are better poised now because we took action then than if we took no action, still waiting on it. So I would proceed with caution. And in real estate, I would make the decisions about investing with all the information that you currently have on hand. And again, to Howard Mark's point, if news about a wave of foreclosures that is factual, like actually backed up and is in the process of happening, or if prices are, decreasing still, or I don't know, any signs of a recession in real estate, then sure, you're going to want to take that into consideration and be agile and kind of pivot your strategy. In the meantime, we're going to continue purchasing properties, analyzing them as we have been, and continuing to look at the best deals. And I would say as well, some of the investors that I know, they have been buying properties since the 90s. They really substantially increased their portfolio during the 2008 housing crash when the property values greatly decreased. And some of those have slowed down on acquiring properties because the prices are getting so much higher than they are used to. And I can see that and I respect that. But as we analyze properties, and I'm thinking out loud here, and it might be funny if all this is used against me at some point, but again, thinking out loud. So if we are analyzing properties in a manner where 75% of the after repair value is our all-in price. So if purchase price plus renovations price is 75% of the after repair value or less, then the properties can from let's use 2016 when the all-in price was 40,000. These properties would likely appraise for 60 or 75,000. Well, now while the all-in price might be 65, 75,000, proportionately the properties will now appraise for the 130 to 140 range. So if we are staying true from a percentage standpoint, then whether we're paying $5,000 on the purchase price or $50,000 on the purchase price, the formula is the same, as it's a percentage of the money invested rather than kind of fixed rate things. So I think that should count for something. So we're going to continue analyzing and making sure that each time we purchase a property, the purchase price plus the rehab costs are equal to or less than 75% of the after repair value. And as we're doing this, if the market does turn, then our total exposure is only the properties that we have on short-term financing, not long-term. The properties that we already have on long-term financing, they're kind of already at home plate, right? It's very uncommon for long-term loans secured by real estate that are fixed ever get called or anything like that. So the biggest exposure if the market hits are all of the properties that we have on short-term financing. Our business model is to convert those to long-term financing. But if the market tanks and our formula is, let's say we're all in at 75% of the after repair value, but now the market tanks 25%. So now the 75% we were at and we were planning on is now 100% of the value. So we may have to put money into these properties in order to refinance. However, we should still be able to refinance on long-term loans, so long as there are still banks that still have funds that still want to lend them on a long-term basis. Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.